9 a.m. in Beijing and Hong Kong. Welcome to Bloomberg Markets China Open. I'm Yvonne Man with David Ingles.
Yep, let's get to your top stories today. Stocks across the region getting a positive lead in with Wall Street building on record highs. Investors now weighing rates and economic outlook as earnings season kicks into high gear. China's premier ordering a more forceful response to the country's stock market rout as the benchmark crumbles to a 5-year low. And also ahead, we're live at a Goldman Sachs Global Macro Conference in Hong Kong with the bank's chief China economist.
And I'm Stephen Engel outside the Bank of Japan in Tokyo, where investors will be watching for any hints of rates liftoff from today's meeting amid, of course, easing inflation and soft demand.
Yep, lots to talk about this hour. Welcome to the program. Hope you're all well. We'll start off with some breaking news concerning what's been happening in this Chinese market and also where Steve is also in Japan. Hedge fund Asia Genesis is shutting down after a big mistake on China trade. They've lost a drawdown 19% almost in just the first few weeks of January. Singapore-based, of course, this fund, they're closing their macro fund after suffering unprecedented drawdown following the rout in China and also the rally that's taken place in Japan. On that very note, our starting point this Tuesday, futures in Singapore are pointing higher. Take note, this time yesterday, that was also our starting point. Futures were pointing higher, and then Monday happened, effectively. U.S. futures are doing this. Japan continues that rally. It's now 37,000. It's very much, at least very much on the horizon, if you will. 300 points to that benchmark. Of course, we'll talk more about the prospects for the BOJ today. In the meantime, the focus certainly is with these Chinese markets. With, for one, you had that blow up in structured products onshore. You have more forceful measures promised out of Beijing. We'll see what happens across the open today. Let's have a look at what we're seeing across markets like Taiwan, Singapore, and Malaysia coming online. And Taiwan, speaking of, we're within about 4% of a record high on that specific index. Currency markets, dollar yen, dollar China, euro. Very much in focus. The dollar's going to come up bottom of your screens. Yen is near at 148 and change, near a 2-month low against the U.S. dollar. Bond markets are tense. Japan, U.S., China, and Australia are doing this. And you now have a 2.4 handle on your Chinese 10-year yield as, I guess, the prospects of more stimulus looms quite large there. Quick glance at commodity markets doing this. Very, very briefly, oil and bottom of your screens, of course, some of the cyclical equities tied to what's been happening in the commodity space. This has been, on equity-wise, this sector has been your worst performer in the region so far year to date. Speaking of worst performer, globally, the Hang Seng Index is near bottom of the barrel globally. In fact, several measures going into today are screaming, at least on a technical level, buy. Right? Whether you act on that information is another thing altogether. Half the index is at a 52-month low. Nearly half is below this RSI of 30, which indicates maybe oversold conditions. And in terms of valuation, about a fourth of this index, as you can see, has now book value below 1 time. Okay, a couple of things we're also tracking today. We're very close to taking out on the Hang Seng China benchmark the 2022 low and also the GFC low. Below that, it's back to the levels last seen, I guess, 2005, 2006. And speaking of a possible valuation bottom, Hang Seng Index, we talked about this, on an index level is now below 0.9. So that's, at least in the last 10 years or so, has preceded major rallies, the 3 biggest rallies of the last 10 years or so. Does this fourth month indicate, Yvonne, a possible bottom? I guess we have to wait and see, Yvonne.
Yeah, we talked to Tim Mo about that, right? That perhaps we have seen some sort of, floor. I mean, does it get any worse than this when it comes to Hong Kong? That certainly is one big question, but it just came out with a report on several factors need to be put in place before we see some sort of stabilization and consolidation here right now. Let's bring in our roundtable to talk more about this. Our Asia equities reporter, Charlotte Yang, also our MLive strategist, Mark Cranfield. Charlotte, we talked about, is this capitulation? I mean, obviously, tell us a bit about what really happened yesterday. Obviously, these snowball derivatives had a bit of a snowballing effect to all of this.
Yeah, so I think perhaps the number one thing that's keeping a lot of investors on edge is about the spillover effect, from these snowball products. So these structured products onshore are mainly sold by brokerages to institutional investors as well as qualified retail investors. They're predominantly tied to the small cap indexes, CSI 500 and CSI 1000. And if based on CICC's estimates, so to be sure, different brokerages have different estimates. The CSI 500 has already failed to the level, the estimate that could trigger the massive knocking of snowball products, and because of the hedges against those knockings levels, have to be unwind, which could create selling pressures for the broader market. And if we're looking at CSI 1000 index, we're just 4 points away, from the estimate based from CICC. So I think how these retail structured products and the spillover effect from that, if the indexes fail further, that's keeping a lot of people on edge at the moment.
Mark, I'll bring you in. When we talk about market structure, and we don't normally do that, in the rare case that we do like today, it brings to mind really the depths of this market. Just your thoughts really on, is a bottom close, Mark?
Probably a near-term bottom, I think, is a decent chance here. As all those oversold indicators you talked about are all relevant. You had this massive selling yesterday, probably related to snowball derivatives. Also had comments overnight from the Chinese premier that he wants to see more forceful action to support the market. So if you're walking in cold today, you probably think, yeah, there's a chance of a short-term bounce here, and it wouldn't be surprising if we have a green day today across the Hong Kong markets. But there are still a lot of things missing here. One of the interesting things was back in the fourth quarter of 2022, when we had the start of that huge rebound in Hong Kong equities. We had a couple of days when turnover was above 5 billion shares. We haven't seen that either for the Hang Seng or the 8 shares index yet. So we're still missing the sign in terms of people coming back into the market in big numbers. That's still absent. We also don't have a real fix for the property market as well. There's lots of reports suggesting that the property malaise in China will continue at least through this year. So it's one thing for the authorities to say they want to see action, but if they don't address the bigger issues, such as property, and stop doing ad hoc clampdowns on tech companies, investors will still be very shy of putting serious money back into the market.
Charlotte, I'll bring you in. A feature last year, last 2 or 3 months, you have a lot of these sell-side reports coming out, and you had analysts almost calling a bottom to the market. We're 10-15% lower in price from that time, and it seems this time around, not a lot of people are willing to call the bottom. What gives?
Yeah, right now it's very hard, even though, from the technical sector, like indicators, you can see, for example, like half of the HSI members have been oversold, and other indicators, it's getting harder and harder for people to willing to call bottom. And what we're seeing is that increasingly there are more Wall Street shops calling for investors to adopt a more defensive approach in this difficult environment, such as buying stocks with high dividends, that type of defensive play. I think the broader picture here is that, it's really hard to call, especially a bottom in sentiment for China at the moment. It's really a confidence trap, and because of those bigger issues that weren't solved, and investors really need to see more than words and actual real actions coming from policymakers to repair confidence. And also with U.S., you have also Trump maybe coming out more elections risks over there. A lot of this is it will take a lot of actions to rebuild the confidence.
Well, we did hear from the Chinese Premier Li Qiang, who I think oversaw a meeting to talk about possibilities or options on this market. He called for more forceful measures.
Yeah, I do think that the authorities are definitely paying a lot of attention to what's happening on the equity market here, given this is also a lot of the retail investors, especially onshore, is predominantly by retail investors. How this market performs also means a lot to their wealth effect, and that's going to have a longer-term implications for consumptions, investment as well.
Mark, obviously, like I brought out, we also have BOJ Day today. I mean, most people think they're not going to do anything, but are there any sort of market implications at all?
Yeah, certainly the press conference is really where the action is going to be. This Governor Ueda seems to be much more open and forthcoming with his information than his predecessor was. We saw in the December press conference there were decent moves in dollar yen and JGB futures as well. He seems to provide a lot more forward-looking information than we're used to from previous BOJ people. So it's quite likely there'll be some action, and he may well give some guidelines on his view of when the right time is to exit negative rates. Unlikely to be today, but he may make it a little bit clearer whether it's going to be April or July or some other time, and traders will definitely latch on to that. And also, from the Hong Kong point of view, they could do with for Japanese equities finding a bit of a top, because the trouble is momentum players go where the hot money is moving. And right now, Japan and the US equity markets still look very attractive. And until they slow down, people from Hong Kong are not going to be putting their money there. They're going to be going back to what's the low-hanging fruit. Right now, Japan pushing the Nikkei above 37,000. That looks like the most obvious trade in the market.
Sticking with the winners. Mark, thank you so much. Mark Cranfield in Singapore, Charlotte Yang here in Hong Kong for us. Yvonne, I'll bring you back in, and certainly quite a timely time to have a conversation around China. You are, of course, where the guys at Goldman are, of course, with this macro conference, and I'm wondering, we've been talking about whether this market is a bottom. We've been focusing on, your sort of usual market measures, right? Fundamentals, price to earnings, price to book. And we've been looking at that for many months, and for many months they've actually been saying buy. But we could be looking at, are we looking at the right metrics is what I'm trying to get to. As Charlotte was pointing out, this could be a sentiment issue. What are you hearing on the ground?
Yeah, and I think it seems to be that, not just sentiment, but also the structural challenges of this economy. Given that this is going to be dominating the conversations, I believe, here at the Goldman Global Macro Conference, is that where is this economy headed here right now? And we talked to several guests, Tim Mo, who covers obviously Asia equities, and why we've seen this intense selling pressure in China. For one thing, he mentioned he did blame on some of these snowball derivatives really exacerbating some of these losses, but also there's needs several factors before we can set a floor on these markets. The policy is one thing. You need geopolitical tensions to come down a little bit as well for us to establish some sort of floor. And Jan Hatzius is also talking about, look, yes, we might see some stabilization in the property market, but that does still, these headwinds are going to linger. Take a listen.
There's a clear recognition that China is facing significant structural challenges. Those are, I'm sure, are well known, but they're, I guess, broadly more in concerns over the property market, over debt, over demographics, over slowing growth, and so forth. There's also been concern that there has not been as forceful a policy response as people have been hoping for. And so there's been this progressive slide in the market, punctuated by occasional rallies, but when the actual policy which has been hinted at doesn't fully come through, then people have been selling that.
Our team has argued that the impact on annual growth from property weakness probably diminishes somewhat over time, in part because the property sector just shrinks, and then it's going to have a smaller impact on the macro economy. But these headwinds are still out there. That's the main reason for the deceleration in growth.
And we're going to have plenty of conversations coming up here at the Four Seasons Hotel. Still ahead, Goldman Sachs' chief China economist Hui Shan going to be explaining their upgraded forecast for GDP growth this year. She'll be joining us here at the Global Macro Conference. In our next hour, we'll also hear from Goldman's APAC ex-Japan president Kevin Schneider. Stay tuned for that, Dave.
Yep, lots of good voices coming up here on set in a couple of minutes. The head of Franklin Templeton in the region, Tariq Ahmad, joining us to talk about the business and their outlook and what they see, of course, as the best opportunities right now. We're counting down to the Tuesday Open, just under 16 minutes away in a freezing Hong Kong this morning. The boots are out. Are the bulls out? Futures are pointing higher. 50 minutes to the open. This is Bloomberg Markets China Open. Good morning. All right, welcome back to the show. Can hardly wait to see what this open looks like. Futures are pointing higher. We're looking at the fix of the day out 7:35. Well, no, 7:11, 11:17 there. Okay, I looked at a different line there, not to give anyone a panic. 7:20 was the estimate, so still substantial a gap there. BNY is out with a note, in fact, just dropping these last few minutes or so. They see the yuan depreciating to between, well, the bottom is 7.35 on dollar China, the top is 7.42. Futures are now mixed. There we go, ahead of this open. So looking like a softer opening few minutes. Joining us here on set to talk all things China, all things Japan, looking at the alternatives as well. Joining us is the head of APAC at Franklin Templeton, Tariq Ahmad. Nice to see you. Good morning.
Morning.
How's business?
Business has been good. We had a really good year last year, fantastic year. In fact, a record year for Franklin Templeton Asia Pacific in almost a decade.
What measure?
So in terms of net flows, so we look at the business net flows, so net new money that's coming in across the region.
Talk about China. How's that business doing?
It's been a good business.
Onshore.
So onshore business, so as you know, we have JV, a joint venture with Sealand. That's been a successful venture for us for a long time. So that's ongoing, onshore, offshore. We've been pretty active in the marketplace. And I would say that continues.
Will that continue in its current form? What are you guys talked about options you're looking at with that JV. What are the options? I
mean, China is a very, very important market for Franklin Templeton. We're exploring various options, Sealand included. So, that's an ongoing conversation, we're having. And we're exploring. We are exploring. I think it's an important market for us. Okay. And just looking at China and the growth of China looking ahead. I mean, David, that's a $25 trillion market in terms of addressable assets, retail and institutional. So, for us, that's going to be a market we want to be in. For some time. What the market's been trying to figure out is, is the current JV, is that the right vehicle to take advantage of the future? And I know you've been talking about options. Is the JV partner, are they open to options? Are they willing to sell, for example? We are in discussions. They've been a great partner. So I would say that is, one of the focus for us, looking ahead. Okay. I need to ask you about flows as well, because you oversee, of course, this channel that allows mainland investors to take their money out. Given the market route that we're seeing, what are you seeing as far as flows? Is money still coming out? Longer term. So let's look at the longer term perspective of China. I know the headlines today are negative in terms of looking at the growth, valuations. I mean, China long term has a structural story. You look at the macro. I mean, longer term, there's a play here. Investors are looking at options. So, we are seeing flows coming out of China into global investments. So investors are looking at multi-asset, alternative solutions, and that's kind of where we're positioning our business to kind of really have conversation with clients, to provide them with a solution to advice, in those asset classes, which help them diversify away from China. Which, from any kind of classic portfolio allocation perspective, you want to be diversified across market cycles. And that's really been the question. I mean, it's hard to ignore. Fine, I mean, headlines can change day to day. It's hard to ignore a major market, though, that's down 60-70% with no willing buyers so far. Do you get a sense based on what's your house view on is that more cyclical than structural, or is this simply a cyclical point of weakness right now and we'll get out of it? So we look at the short term and the long term. Right. So I would say structurally, China is a great story. Right. You look at the demographic story. You look at the reforms coming through. I think, David, more importantly, when you look at China for years ahead, I mean, that is an investable asset class to be in, right? Fixed income and equities. Valuations, the dispersion. I mean, the dispersion coming in, you look at the PE measures, you look at the price-to-book measures, the dispersion. So for an active manager, that creates good opportunity for us to kind of really capture a story we think, longer term is compelling. Right. You mentioned alternatives. Is the sort of product solution, how important is alternatives to just managing wealth and overseeing assets, of course, because you guys are quite big, of course, in that. And what are your plans there? And Franklin Templeton took a very strategic and important decision to ensure that we build a platform that gives clients access to public and private markets. Okay. Alternatives is an increasingly important asset class. And what we've done is, David, is kind of really build a platform that can kind of cater for clients across liquid alternatives, private debt, private equity, secondary private equity, real estate. And that's going to be something that's going to be important for us, A, you look at sort of asset allocation activities happening in the region, I would say there has been allocation that's increased across secondary private equity. In fact, one of our managers, Lexington Partners, had one of their best ever record raise last year in terms of secondary PE raise across the region and globally.
Right.
I mean, that was, I think, north of $20 billion. And almost, I would say a significant portion came from Asian investors. So we will see that trend continue to grow into the year as well. But I would just say fixed income this year will be probably more of an important topic in terms of where we are at this cycle. Dovish monetary policies, an easing policy cycle means, fixed income should do really, really well.
Right.
You go back in history, David, over 30 years.
We've never had an entry point like this.
If you look at the Fed in terms of entry points, right?
Yeah.
So when the Fed goes from tightening to an easing sort of stance, fixed income does really, really well. In fact, if you look at the U.S. indices, U.S. Treasury, for instance, majority of the return comes at this point. Now, what's the best entry point? We say, look, I think it's about being invested and staying invested. And now I think in this cycle, being more active is going to be important because, we're back to kind of real rates, normal policy environments. And therefore, you can't really just buy the beta. You've got to buy the alpha. And therefore, where specialist solutions come in from, Franklin Templeton and other managers, where we can provide you bespoke advice and solutions to navigate the cycle, be diversified, and staying invested, David. I think that's going to be important. You've got to stay invested. You've got to think long-term. You've got to kind of avoid the headlines. They're important, but look long-term from a portfolio and a macro perspective.
Very quickly, Japan's come up in a very big way. What are your plans there as a final question?
I mean, Japan is a $6 trillion market, one of the biggest markets out of the U.S. Almost $3 trillion is passive. So the active opportunity is immense, I would say. I mean, Japan has now, initiated NISA, which is the investment savings plan. It's a bit like the UK ISA. I mean, for us, that creates an opportunity in wealth. I would say institutional market is growing at a fast pace. Alternatives are still underinvested. More to come over there as well.
Tariq will pick up on that next time, of course, we speak. Tariq Ahmed there, of course, out of Franklin Temple, head of Asia Pacific. Plenty more ahead. This is Bloomberg. Okay, welcome back to shows. The futures are, well, depends where you look. Onshore, we're slightly weaker. We're higher here in Hong Kong, where really most of the losses were yesterday. So give or take about half of 1% to 1% gains. We're looking at some weakness in the currency, although you did get a stronger fix out of the PBOC earlier on. We are poised to open higher in Hong Kong. We're still waiting for potential measures to stabilize this market after the order from the Chinese premier. Various measures of this market and also updates on that Xinjiang earthquake, which took place early on Tuesday. The Open is next. This is Bloomberg. Okay, the Tuesday session is just ahead, half of 1% to the upside. All that being said, and we saw this coming, it was a slow ship coming. The declines we've seen in Hong Kong mean that as of the close, Hong Kong is now the 5th largest market in the world. It's been overtaken by India, which has now taken that place. We're measuring this by market cap. We'll show you a chart later on in the show. Welcome back to shows. 20 seconds to the opening bell, Yvonne.
Yeah, exactly what we heard from Tim Mo from Goldman Sachs here at the Global Macro Conference here in Asia, that this intra-regional disparity is something that, was so wide in some ways, where North Asia really outperformed. You have Hong Kong, China, and Thailand underperforming last year. He's not seeing that changing anytime soon. And still, his favorite markets are still those North Asias and India in particular, Dave.
Yep, okay, we'll see longer term whether this is a trend or whether or not you can fade this, I guess, in some ways. Let's have a look at the open, please. 0.3% to the downside, CSR 300. Half of 1%. We're back above the 15,000 handle. The next one on MSCI China is 50 at 49. I mean, this takes us also very near this. The Hang Seng China Index are both extremely close to taking out the GFC lows. We are seeing a bounce today. We'll see how long this lasts. We're waiting for many, many things. We're looking at volumes on index futures on the back of the blow up in some of those structured products, of course, onshore. We're looking at potentially more measures coming out of officials today. We heard from the Chinese premier vowing more forceful measures to stabilize confidence in this market. Flip the boards, please, across sectors. Here's how things look. You have the major sector groups. Financials are down. Most are still down onshore, as you can see. Most of the constituents offshore here in Hong Kong are seeing some upsides. So some of your consumer services names, consumer discretionary names are catching a bid. Developers are also seeing a little bit of upside today. Let's have a look underneath the hood, and really coming off a day where everything was virtually down in Hong Kong. This is how the opening bell looks. That's a split within the Hang Seng Index. And we are seeing some decent buying leftmost side of your screens. At the moment, breadth is favoring gainers at the moment. We're looking at about 50 up. A good portion, though, still down for the day. Let's give this market time to warm up and see where we are in a couple of minutes here. Let's take a longer-term view here. The value of the stock market has never been this far behind, in fact, that of the U.S. You've losses piling up. We just talked about, of course, Hong Kong vis-a-vis India. Let's bring in Abhishek Vishnoi, our Asia Equity Senior Reporter, who's been looking at this specific valuation gap, Abhishek, with the U.S., and what can you tell us, and how wide is that gap right now?
Well, David, the gap is at a record. The gap between US and China and HK put together is about 38 trillion right now, and that is as of the close of 21st. The falls that we have seen in the previous session are yet to be accounted for. It's also a record valuation dispersion between the two markets. MSCI China has never been this cheap against the US equities right now, and this just shows the divergence between the outlook of the two markets, the presence of Magnificent Seven in the US market, the turn of Fed towards easing, well, the potential turn, and China's unique issues and geopolitical tensions. To some investors, it's also pointing towards, the crumbling of the narrative that China would be overtaking U.S. GDP in matter of a few decades. That narrative is sort of crumbling down. That's what these records and valuation dispersions, record and market value gap are showing to some of the investors.
So Abhishek, given just how extreme this disparity is that we're seeing, whether it's U.S.-China markets, whether it's India and Hong Kong that we just reached this milestone, are there any signs of a turnaround? Is there light at the end of this tunnel now?
Well, the signs of turnaround, from valuation points are already there. We have, reported time and again how cheap market is. But the market keeps getting cheaper. Now, the context here is that the government needs to walk the talk as far as China is concerned. There needs to be a lot more stimulus that market has been asking for, and government has not been delivering. Piecemeal approach is not going to work. That's number one. The second thing is that, this is a very liquidity-driven market. This means, the net flow of liquidity is negative for China. So, that needs to turn positive. So the signs of that are still not there. Western world is still selling China stocks. They don't want to own it because of whatever reasons. And the sentiment back home in onshore as well as offshore like HK market is not that great. So that buying needs to come in without government intervention from local residents first. As at this point in time, those signs are not there. One more thing, in this whole context of valuation, it is cheap, but right now China needs to be compared with how Japan was. If you go back in history, look at 2007 and 5 years from that, Japan traded under book for a long time, and same for Korea as well. So right now the context is that valuations may remain cheap. Earnings and government measures would drive the market. So these two things, coupled with sentiments, are what is required for the market to move higher.
All right, Abhishek, thank you. Abhishek Vishnoi, their Asia Equity Senior Reporter, joining us out of Singapore. Let's bring it back to here in Hong Kong. The annual Goldman Sachs Global Macro Conference is underway here. Joining us now is Hui Shan, the bank's chief China economist, here with me. Good to see you again. Let's talk about the sell-off, though. I mean, it's quite intense in terms of the selling pressure we've seen of late. At what point does this actually start hurting and constraining growth in terms of consumption and investment now?
Right. It is quite frustrating to see the market underperforming and outright decline. I think the channels through which the equity market decline impact the real GDP might not be what you think. A lot of people ask us about the wealth effect, right? If individuals are holding stocks, their stock value decline is going to hurt consumption. But in China, we have found that the wealth effect is not that big. The main effect on consumption is income. Yeah. People need to have income to consume. So what we do worry about is the sentiment and confidence impact, kind of reinforcing market going down, reinforcing the bearish sentiment. I think that might be a bigger channel in terms of affecting growth.
So China reached 5.2% without massive stimulus last year. How hard is it going to be to achieve 5% this year?
I think very hard. I think last year 5.2, around 5%, and this year we're forecasting 4.8%, also around 5%. But we think this around 5% is going to be a lot harder than the last year's 5.2%. The reason is that if you look at last year's growth, we estimate about 2 points of that 5.2 was one-off reopening, and that's not going to help you this year. Yeah. So all else equal, you might only get 3.2% this year without that reopening boost. So that's why we think that policymakers really have a lot of work to do to get even close to 5% this year.
Should we be looking at MPC as maybe signs of maybe more forceful stimulus coming through?
They certainly need to create more demand. I don't think monetary policy is at the core center of the stimulus that people should pay attention to. Investors were asking me about LPR yesterday, but I don't think that's the key focus. Whether PBOC cut 10 basis points or not cut 10 basis points, maybe as a signal value, I think the key is the fiscal. You need to directly introduce demand and increase demand in the economy. Increasing liquidity a bit or cutting or raising interest rate is helpful, but it's not essential.
How difficult is it now to, given where deflation is, right? I mean, this is some of the longest run we've seen. I think I was speaking to one of your counterpart, your colleagues, I should say your rivals, I guess, at Morgan Stanley, saying that it's the longest run of deflation we've seen since the Asian financial crisis. Is this something that to you it's more entrenched now? Is it cyclical, or is it something that's structural, that's going to take some years to get out of?
It is the longest. We have 3/4 of GDP deflator declining, and that is the longest since the Asia financial crisis. It is hard to judge how long that's going to persist. You can certainly argue that there are cyclical factors, whether it's commodity prices, whether it's pork prices, that should fade eventually. But at the same time, we do see some structural issues. For example, we have overcapacity in a lot of industries, including electric vehicles. So if industrial sectors will continue to invest in manufacturing capacity, continue to produce without stimulating demand, then certainly prices are going to be weak.
Jan Hatzius was saying at least the drag from the property market is a little bit less on China, maybe moving forward. But have we seen at least the tail risks related to the real estate market? Has that started to fade a little bit now?
Right. On the property market, I think when I talk to clients, a lot of times the people are still uncertain, because if you look around the world in historical housing cycle, it takes a long time to get housing market to bottom. Think about in the U.S. housing market peak in 2006. When did the markets realize the housing finally bottom and start to move up? 2011. So it took a long time for the housing market to turn around. We only had a housing peak in 2021. So I think with this magnitude of a decline, investors are certainly justified to sit on the sideline and trying to watch for signs that things are bottoming.
So how do we get out of this vicious cycle of companies trimming their debt, they're cutting capex and hiring, and that's going to lead to more jobs and in terms of wage growth deterioration? I mean, how do we get out of this vicious cycle now?
I think think we need to take a bit more balanced view. It is true there are a lot of a vicious cycle going on and some risks of it, to the downside. But at the same time, when you look at the data, you also see 2023 was a year of China recovering. You look at large cities unemployment rate versus a small city unemployment rate. Used to be large city has a stronger labor market, unemployment rate being lower, but during COVID, they had a higher unemployment rate. And now finally their unemployment rate is coming down. So there's also a cyclical component of it. We need for that to play out, and we need to see how policymakers address those downside risks.
Should we start even thinking about what, a U.S. election outcome with Trump coming back in office potentially? What does that mean for China? How disruptive could it be?
Certainly, this is a key point of client conversations. Market is always forward-looking, and with Trump winning Iowa, this is coming to sort of people's attention. I think for Chinese investors or investors interested in China, it is a risk. But I think it goes beyond that. I think looking at what Trump has been saying is not just tariffs on China, also potentially has trade barriers increased for other economies. What does that mean? How does that? Because the trade is always a competitive advantage. So I think it's going to be quite messy and quite complicated to figure out how China's role is going to evolve. 2018-19, it was U.S.-China trade war. But going forward, if Trump does increase tariffs on a broader set of economies, it's going to be different.
Wei Shan, great to talk to you. Chief China economist at Goldman Sachs, joining us here at the Global Macro Conference here. We have plenty more coming up in terms of guests here, and a big one coming up as well with Kevin Schneider. He is, of course, Goldman Sachs APAC ex-Japan president, joining us here at the top of the hour.
Get to some of your other China stories that we're tracking today. A very powerful earthquake actually rocked Xinjiang region, 7.1 magnitude, rocked the western Xinjiang region early on Tuesday. According to state media, the quake hit Wuxi county in Aksu prefecture around 2 a.m. At least 2 houses were destroyed and dozens of trains in the region were suspended. There were no immediate reports of casualties. More than a dozen aftershocks have since been recorded. Now, China has released a pilot plan to develop Shanghai's Pudong district. That's, of course, where the financial district already is. According to Chinese media, the move is aimed at encouraging the development of venture capital and angel investor groups. Now, Beijing is trying to boost investor confidence. That's as markets like the CSI 300 or the Shanghai Composite you see on your screens have hit multi-year lows. Right, just ahead, we're live out of the Bank of Japan in the headquarters there. We'll be talking about the prospects, and ahead of that, of course, a brief look at markets in the Chinese mainland. There you go. You have Japan, and of course, it's BOJ Day as well. So lots to consider, lots on the plate for investors, plenty more ahead. This is Bloomberg.
If you think about it, so what would happen to the next, then we would like to confirm that as far as fundamentals are concerned, it is going toward the direction what the BOJ is looking at. So that sort of thing I would like to confirm with today's monetary policy.
Toshitaka Sekene there, the former research chief at the Bank of Japan, and really saying, Dave, it's been quite interesting, right? He said, the fundamentals are there for the BOJ to start pivoting. He was actually forecasting it in the January camp, but then because of the scandals, because of this earthquake, there are still some uncertainties that maybe that will hold off the Bank of Japan here later on today. But certainly, he says, economically speaking, they should be ready to go. And that is where we're going to bring in our Chief North Asia Correspondent, Steve Engel, joining us outside the Bank of Japan here this morning. And Steve, it seems like it's a consensus that they're not going to do anything this time around. We mentioned some of the factors that have happened in the last few weeks or months, but what are we expecting?
We're not expecting much as far as, of course, any kind of hike or move on the main policy rate. That's pretty much a foregone conclusion. I'm willing to be surprised, but the economists surveyed by Bloomberg, all of them, 51 I believe it is, all say, nope, it's not going to happen at this meeting. We're going to get those, that decision momentarily within the next couple of hours, followed by what's probably more important, if indeed they do not move. That will be Governor Ueda's comments coming at the press conference at 3:30 local time. So, investors, economists, everybody, including myself, will be listening to any clues as to changes in the outlook for inflation, because keep in mind, the inflationary environment has been above 2% since essentially mid-2022, the target of 2%. And right now, it's still above that. Yes, it's going to be coming off a little bit. We might get a revision, according to the Nikkei newspaper, on fiscal 2024 and 2025 for the BOJ's outlook for inflation. But right now, still, the inflationary environment, as that guest had just said, is probably good enough to see an exit from negative rates right now. But again, the dovish stance of the BOJ is probably just being a little bit more cautious. They want sustainability even further, maybe until April is what most of the economists are forecasting for any kind of rate hike from the BOJ on the main policy rate. They want to see not only stable inflation, but stable inflation backed by wage gains. That's why we're going to be watching the imminent beginning of the negotiations for the annual Shunto, which is the negotiations between the labor unions and companies. And if they do get the kind of gains, the BOJ gets the kind of wage gains from the Shunto negotiations, that would be mid-March. So then an April hike, if those wage gains come through, would probably be most likely.
Then, Steve, that almost shifts the conversation, and we just showed that graphic that you alluded to, that in April seems to be currently the preferred meeting for economists. Might we be talking about July come April if we don't get anything then?
Well, 45 of the 50 economists surveyed by Bloomberg say it's going to happen by July. Okay, so 68%, so 34 of those 50 feel April's probably the right time. And April, the timing again is perhaps in lockstep with the ECB and Fed. If the ECB and Fed are going to be soon mid-year, perhaps cutting interest rates, the Bank of Japan, if they do a hike by April, the timing would probably be better to have some sort of hike from the BOJ before the ECB and the Fed start cutting.
Okay.
So again, July, most likely. 90% of the economists surveyed say it's going to happen by July, as long as those wage gains come through.
Yeah, okay, Steve, let me pick up here. And final question, I'm wondering how it feels. How does it feel to be on the ground? I mean, we talk about, we brought you in with, a setup that effectively said the economy's there, right? The fundamentals are there. It's now about the mindset. How do we get over 2-3 decades of a mindset where prices are falling? We're not going to make babies. Have mindsets changed on the ground? Are people going to go forth and multiply? Are they going to hire? Are they going to hike wages? How does the economy feel?
Well, that's why I think the BOJ Board of Directors is essentially being cautious right now. They don't want to get the political blowback for basically removing stimulus too soon. It's happened in the past. So again, households are a little bit skittish right now. Because you've had 2 years of inflation after several decades of deflation, it's been a shock to the system. And of course, the energy prices have raised the prices at the household level. Essentially, with wage gains lagging prices, households have seen their real incomes fall for 20 straight months through November. So they're feeling their pocketbook a little thinner right now. So again, yes, the stock market rally has been great for sentiment, obviously. And again, the weaker yen has been good to a certain degree, but it has led to essentially higher input costs on energy and the like. So a weak yen at 148 has raised that import bill for the Japanese. And I talked to one shop owner out at the outlet malls at Gotemba out near Mount Fuji on the weekend, and I was saying, wow, everything is cheap here. It's great. And he goes, it's not great for us. I went to the U.S. and everything was so expensive. I need to save money. So again, that's what we're talking about here as far as the household sentiment.
Yeah, well, the two sides to a yen at 148. Certainly Stephen Engel, who I imagine is taking advantage of a weak yen. There we go in Tokyo for us ahead of the BOJ, which should be out within the next 2 hours or so. Okay, now back to the markets here, this side of the world. We're hearing from Hong Kong Chief Executive John Lee. He is speaking at a briefing, which I imagine is the weekly briefing. And it's ready to talk about markets, but why not, given the moves we've seen this week so far, that markets are operating in an orderly manner. There is no unusual activity, according to the Hong Kong Chief Executive. Plenty more ahead. This is Bloomberg. Okay, there we go. The benchmark situation is looking better here in Hong Kong. Not much better onshore, where we're still reeling really from the blow up in some structured products there, of course, taking out some key levels there. CSI 300 to 500 is focused. The 1,000 in terms of index futures. Underneath the hood, MOV looks like this. 51 up on the Hang Seng, 29 down, 2 unchanged. Broadly higher, 0.5%. This is Bloomberg.